Hi, today I'm going to explain a lot of what I have learned to look for when searching for an investment that could return you 100x. So imagine investing $10,000 into a company and seeing it turn into $1 million. Let's break that down, what to look for in an investment to hopefully pull off this magical 100 bagger. Now, if you're new to my channel, well, welcome. My videos are about investments that anyone in the world can make. And I'm trying to help as many people as possible understand what it is they're actually investing in. Most people spend more time researching the next phone or computer than they do their next investment. Now, I have built a reasonable sized portfolio that I'm aiming to grow at about 20% per year. That's the goal. And I base a lot of my knowledge on the great investors: Peter Lynch, Warren Buffett, Charlie Munger, Monish Pabrai, and a handful of others. Now, of course, I'm not perfect at this. Not every investment that I make is going to be amazing and go 100 times, but we definitely will find some great investments and push for that 20% per annum goal. Now, in this video, I'm going to be referring a lot to the book by Christopher Mayer titled 100 Baggers. Look, it's a good book, maybe a little more for an experienced investor rather than a beginner, but it highlights some great ideas that I'll share with you today. ROIC is a very important metric, and it's how businesses can reinvest their free cash flow in a manner that continues to earn above average returns. Look, sometimes it's called return on capital or return on invested capital or return on capital employed. These acronyms, they're all the same metric. Look, all you need to know is the higher and more consistent this ROIC number is, the better the business is at investing its money to make more money. So here are some examples of companies that I have investigated recently with great ROIC numbers currently and over the past 5 years on average. We've got Electronic Arts. Their current ROIC is 22% and their 5-year average is a big 28%. Facebook's ROIC at the moment is 40% and their 5-year average is a great 31%. Skyworks is currently at 28% and their average for the last 5 years is 32%. Alphabet, or Google, currently is 24% and they average 25%. Biogen currently is 17% and they average 26%. And Nvidia, currently 30%, their 5-year average is a massive 60%. Now, when a company pays a dividend, it has that much less capital to reinvest. Instead, you get the money in your trading account and you have to pay taxes on that as well. Ideally, you want to find a company that can reinvest that money at a high rate. You will end up with a far bigger pile at the end of the day and you'll pay far less taxes. I explain this in far more detail in my video about why dividends are bad. So if you're a little confused why dividends are actually really bad news, well, please go check that video out. Now, you're going to need time for the investment to grow 100 times. If ROIC can be consistently 20%, well, it will take around 25 years to turn $10,000 into $1 million. The worst thing you can do is sell out of the company early. For example, if you sold out at, say, 10 years, you would get 6 times your investment. That sounds pretty good, and you might want to use that money to put down a deposit towards a house or something. But let me explain, that would be a very expensive mistake and a very expensive house, because after just 15 more years, you would have $1 million. That is how compounding works. The results accelerate. So as long as the business can deliver this good ROIC, don't touch it. Now, 25 years is pretty great, getting to $1 million, but imagine just leaving it there for another 15 years. So that's 40 years in total. You would have turned your $10,000 into $15 million. Those extra 15 years, you added another $14 million. This is serious compounding at work. Just leave your investment alone, try to forget about them in the short term. 80 to 90% of experts out there talk about a diversified portfolio strategy. Putting some money in stocks, real estate, bonds, gold, international markets, cash, but that's not how finding a 100 bagger works. The people who have been able to get 100 baggers are not diversified into lots of different things. They concentrate their investments in just a handful of companies. The idea is that you are wasting your money in so-called safe assets that can't get you a 100 times return. Don't waste your efforts on anything small where you might make a few dollars. Focus in on a handful of investments that could be huge. You only have so much time and so many resources to devote to stock research, so go for the 100 baggers. 100 baggers are all growth companies, simple as that. Now, we get earnings reports quarter by quarter, But that's not a long-term assessment of the company. See, fluctuations happen and businesses take a year or two to develop products and strategies. So make sure to ignore short-term declines in growth and look for those longer-term growth rates. Amazon has a PE ratio of 90 on earnings of $34 per share. For Amazon to be a 100 bagger, well, earnings would have to go up 100 times to $3,400 per share from that $34, and the PE ratio needs to stay at 90. But if the PE ratio falls to a more industry average of say 45 even, then the earnings will have to rise 200 times to $6,800 per share from $34. Look, just don't make investing so hard. Pay fair prices. Don't pay too much. To find out if you are paying too much and you want to find that fair value, well, check out my intrinsic value calculator in the description, and it's free. Plus, I have a tutorial video explaining how to use it and how to find the growth rates and how they're factored in. I think this is an important point and something that I've started paying more attention to myself personally. If we were to look at a company under, say, $2 billion in size, then the market can handle growth rates of 20% per year for a long period. Apple has been and is a fantastic company, but it won't be a 100 bagger at current levels. The market values Apple at around $2 trillion. So a 100x return from here would be $200 trillion. $200 trillion? That would be double the entire world economy. That's not going to happen. Unfortunately, the laws of large numbers start to work against you at some point. I think the right place to look is companies under $10 billion, maybe even under $2 billion is probably a better starting point. This is a point I highlighted with my analysis of Dropbox. 100 bagger stocks tend to have a CEO who is the majority owner as well. Therefore, the CEO's net worth and success is tied to the company. Everyone's interests are aligned, and this is exactly what we need. Imagine if the CEO was getting $1 million a year in a salary but didn't have any ownership. Well, the decisions that they make might not be in the best interest of the owners, rather in the best interest for him or her to keep their job. They don't have any skin in the outcome of the company. This isn't a necessary requirement at all, but a good sign the CEO is also a big owner. That's a really good sign of a potential 100 bagger. There is a million people every day trying to get your attention by predicting the market crash, talking about oil prices, calculating what will happen when a vaccine is released. Apparently every day something important is happening. It's all a pathetic waste of time and will distract you from your goals. Stock prices move for all kinds of reasons and sometimes dramatically, but the business changes only very slowly over time. How likely are you to see a 30% dramatic fall in a company's share price and think you need to sell or get out? Maybe you wait a little for the stock to recover and then you will sell. Look, all of this is a complete waste of time in the search of a 100 bagger. Just because the S&P 500 is overvalued and everyone is saying that the market is too hot and overpriced, well, it doesn't mean you should give up on your search for a 100 bagger. This is all just noise, again, and unless you are investing in index funds, well, it really doesn't matter. Between 1966 and 1982, the S&P 500 was flat, considered dead money for stocks. So a lot of people would tell you that you shouldn't be in stocks during these overvalued times. But there were actually 187 stocks that you could have bought between 1966 and 1982 that would have given you a 100 bagger. And some stocks you didn't even have to wait very long. So don't worry about the overall stock market, it just doesn't matter. If the return on invested capital is still good, don't sell. Once you have a good thing, let it compound even more. So if the return on invested capital has been consistently poor for 5 years in a row and the business has lost its competitive advantage, then maybe you can reluctantly sell. It is really hard to know when to sell, so generally it is safer not to do anything. The less you sell, the better. The rise of some companies to 100 baggers is unfortunately unpredictable. So although you don't want to diversify outside of stocks, you do need a handful of companies. 20 would be the absolute maximum, better around 10 and have more money in those 10. Some companies you think are just sure things, but a new technology then comes along that you would have never predicted and it just changes the industry. So there is an element of luck, but you can increase your chances by investing heavily in a handful of companies that have strong and consistent ROIC at fair prices. Maybe you get 3 or 4 out of 10 go higher than 50x. That would make you extremely rich. Sure, if you hold for a long period of time, you're probably going to see one of your investments go to zero, and that happens. But the couple of big wins you get, especially investing in a 100 bagger, will more than make up for the company that goes to zero. Let me explain that in a little bit more detail. So let's say you have a portfolio where you have 10 investments, all of $10,000 each. Here is the big list here of companies you've invested in for $10,000. You invested in all these companies that were under $10 billion in market size, had high and consistent ROIC, they pay 0 dividends or a really tiny dividend, and you bought at fair prices and you didn't sell any of them. But you just made a few mistakes because, of course, you can't predict the future. 8 of these companies went to zero over a 15-year period. That would be absolutely insane. Normally, you could expect these companies to still exist and be worth something, but let's just assume absolute terrible luck. But Company Green was over 50x and Company Brown went over 100x because they just kept doing the same thing and grew. So after 15 years, you would have $1.5 million. And even though 8 companies went to zero, that's still a 15 times return on your investment. Imagine now what would happen if you did a good job and found 4 or 5 companies that did 50 to 100x. Look, I think there's every possibility of 30xing your money even more, and this type of result is what 100 bagger hunting is all about. A big thank you to staying to the end of the video. Let me know what you think of hunting for 100 baggers, and if you have read the book, I'm very interested to hear your opinions. Please hit subscribe so you don't miss any of my future videos, and I will see you next time.